What if I told you one of the largest investment funds in America wasn't run by Wall Street, wasn't owned by Silicon Valley, and wasn't managed by a hedge fund billionaire, but by a church? Not just any church, the Church of Jesus Christ of Latter-day Saints. Behind quiet office buildings in Salt Lake City, behind layers of shell companies, behind decades of silence, a financial operation quietly compounded wealth into something few outsiders expected. A portfolio estimated at over $100 billion. But here's the real question and the mystery we're unraveling today. Why was this investment empire built in secrecy? How did it grow so large without public awareness? And what happens when faith, finance, and institutional power collide? Because this story is not just about money, it's about systems, incentives, trust, and what happens when an organization designed for spiritual leadership begins operating like one of the world's most disciplined financial institutions. Let's begin where it all started. To understand Ensign Peak, you first have to understand the unique structure of the LDS Church itself. Unlike many religious organizations that rely heavily on donations for operating costs, the LDS Church follows a strict principle of tithing. Members are encouraged to donate 10% of their income. This isn't a suggestion. It's a core religious practice tied to temple participation and spiritual standing. Now combine that with three powerful factors: a global membership base, highly disciplined financial governance, a culture built around long-term planning and self-reliance, and you get something rare, predictable, recurring capital inflow at massive scale. By the late 20th century, church leadership faced a new problem: not debt, not scarcity, but surplus. Millions were flowing in every year. And the question became, what do you do when donations exceed spending needs? That decision would quietly give birth to one of the largest religious investment funds in modern history. In 1997, the LDS Church created a private investment entity called Ensign Peak Advisors. Officially, its mission was simple: manage excess tithing funds responsibly, build reserves for economic downturns, preserve the church's financial future. But the structure was strategic. Ensign Peak was not publicly branded as part of the church. It was registered as a non-profit investment advisor. Its employees signed confidentiality agreements. Its operations were intentionally low. Why? Because leadership believed public knowledge of massive reserves could discourage members from donating. From a behavioral standpoint, this makes sense. If people believe an institution is already wealthy, generosity declines. So secrecy became part of the design. And that secrecy gave Ensign Peak the freedom to operate like a professional institutional investor without public pressure, without quarterly reporting expectations, and without shareholder activism. That's when the compounding machine truly began. In the early years, Ensign Peak reportedly managed only a few $1 billion. But unlike hedge funds chasing aggressive returns, their approach was conservative, methodical, and long-term. They invested primarily in blue-chip stocks, broad market index funds, bonds, large institutional positions in major corporations. This strategy didn't make headlines. It didn't produce flashy gains. But it did something far more powerful. It quietly compounded. Let's put this into perspective. If you invest $1 billion and earn just 7% annually, the historical stock market average that becomes nearly $8 billion after 30 years. Now imagine adding billions in new inflows every single year, and never needing to withdraw significant amounts. That's exactly what Ensign Peak had. While many charities spend donations immediately, Ensign Peak allowed surplus funds to accumulate, year after year, reinvested, growing exponentially. By the early 2010s, insiders would later reveal that Ensign Peak's portfolio had ballooned into tens of billions of dollars, but the public still didn't know. Here's where the story takes a more complex turn. Instead of filing investments under one transparent name, Ensign Peak used multiple shell companies to report stock holdings. Each entity held small portions of the total portfolio. Individually, they appeared insignificant. Together, they formed a massive financial footprint. This fragmentation wasn't accidental. According to later investigations, the goal was to avoid triggering attention from regulators, media, and church members. Again, leadership feared perception more than legality. They weren't hiding illegal activity, they were hiding scale. But hiding scale creates its own risks. And eventually, the system cracked. In 2019, a former Ensign Peak employee came forward. He filed a whistleblower complaint with federal authorities. alleging that the church had misled regulators and members by obscuring the size of its investment holdings. This wasn't just about money anymore. It was about transparency, governance, and trust. The complaint triggered federal scrutiny. For the first time, the curtain was being pulled back on Ensign Peak's operations. When the numbers finally surfaced, the reaction was immediate. Reports revealed Ensign Peak managed over $100 billion in assets, making it one of the largest institutional investment funds in the United States, larger than many university endowments, foundations, and sovereign wealth funds. For many church members, this was shocking. They believed donations were primarily funding humanitarian aid, buildings, and operations. Instead, they discovered enormous reserves sitting in financial markets. Critics asked, why accumulate so much wealth? Why not deploy more toward humanitarian work? Why hide the scale? Supporters argued the opposite. The fund ensures long-term stability. It protects the church during downturns. It prevents future financial crises. And suddenly, Ensign Peak was no longer invisible. Here's the deeper pattern most people miss. This wasn't the result of greed. It was the natural outcome of institutional incentives. When organizations receive predictable income, when leadership prioritizes sustainability, when spending is conservative, and when reinvestment becomes policy, accumulation becomes inevitable. The system rewarded saving, not spending, preservation, not distribution, stability, not visibility. But every system eventually creates tension, and that tension exploded into public view. When the Ensign Peak story finally became public, the reaction wasn't limited to media headlines and online debates. It reached Washington, because once federal regulators realized how the LDS Church's investment arm had structured its reporting, questions shifted from morality to compliance. The U.S. Securities and Exchange Commission began investigating whether Ensign Peak had intentionally avoided proper disclosure requirements by using multiple shell companies to report holdings. This wasn't about owning stocks. That's legal. This was about how ownership was reported and whether the structure was designed to prevent transparency. After months of review, the verdict arrived. The SEC concluded that Ensign Peak and the LDS Church had failed to properly disclose beneficial ownership information. The result? A financial penalty, public acknowledgement, and something the church had worked hard to avoid for decades, official confirmation of its massive investment footprint. For the institution, this wasn't a catastrophic loss. The fine was small relative to the portfolio, but symbolically, it mattered, because now the world had proof. The hidden fund was real, the scale was real, and the secrecy had consequences. Once the news broke, reactions split into three camps. Group 1, outrage. Critics accused the church of hoarding wealth instead of deploying it for humanitarian causes. They questioned why a religious institution needed reserves larger than many nations' GDPs. To them, Ensign Peak represented misplaced priorities. Group 2, defense. Supporters argue that financial stewardship is not greed, that responsible investing protects future generations, that the church avoided debt while other institutions collapsed. They saw Ensign Peak as proof of discipline, not deception. Group 3, confusion. Many everyday members simply felt blindsided. They had never been told such a massive financial reserve existed, and this emotional reaction mattered more than any fine, because religious institutions depend on trust. Once trust fractures, rebuilding it is far harder than rebuilding capital. In response to the investigation and media attention, church leadership issued public statements. They emphasized several points. Ensign Peak exists to preserve long-term financial stability. Funds were not used for personal enrichment. Investment growth allows the church to avoid debt. The intent was not to deceive, but to avoid confusion and speculation. But intent doesn't erase perception. Once the numbers were public, the conversation changed permanently. From that point forward, the LDS Church was no longer seen solely as a religious organization. It was now recognized as a major financial institution. You might expect this moment to trigger full financial transparency, annual public reports, detailed breakdowns, open disclosures. That didn't happen. While reporting structures were adjusted to meet regulatory standards, the overall financial system remains largely opaque. Why? Because religious institutions in the United States are not required to publicly disclose detailed financial statements the way public companies are. And this creates a powerful incentive. comply with the minimum legal requirement but reveal as little as possible. So the core tension remains unresolved. Members want trust. Institutions want control. That friction hasn't disappeared. It's simply gone quieter. Here's where the story expands beyond Ensign Peak, because this pattern isn't unique. Across the world, large organizations, religious, educational, non-profit, and even government-affiliated, are building massive investment portfolios quietly. University endowments worth tens of billions, foundations operating like hedge funds, non-profits sitting on enormous reserves. The strategy is the same: preserve capital, grow assets, minimize public scrutiny, maximize long-term influence. What Ensign Peak revealed wasn't an anomaly. It revealed a new institutional model. Organizations that publicly promote mission-driven values while privately operating elite-level financial strategies. And the numbers are staggering. Large endowments and non-profit investment arms now collectively control hundreds of billions of dollars in global markets. They shape stock prices. They influence corporate governance. They quietly accumulate economic power. Without voters, without shareholders, without public accountability. Every time an institution gains predictable revenue and long-term stability, the same cycle occurs. 1. Surplus begins accumulating. 2. Professional investment management is introduced. 3. Compounding accelerates growth. 4. Secrecy becomes convenient. 5. Public exposure triggers backlash. 6. Minimal reforms restore surface-level compliance. Then the cycle resets. We've seen it with universities. We've seen it with foundations. We've seen it with sovereign wealth funds. And now we've seen it with religious institutions. The incentives never change. Only the names do. Here's the uncomfortable philosophical question this story forces us to ask. At what point does financial stewardship become financial hoarding? Is wealth meant to be preserved indefinitely, or deployed to solve immediate human suffering? There's no simple answer. Long-term reserves provide security. Immediate spending provides relief. But when reserves grow faster than humanitarian impact, the optics shift, and institutions risk becoming disconnected from the people funding them. Let's bring this story home with 3 powerful lessons. Ensign Peak didn't need risky investments. It didn't need leverage. It didn't need aggressive speculation. Time plus discipline plus consistent inflows created exponential growth. This is the same principle that applies to individuals, governments, and corporations. Slow money, when left alone long enough, becomes massive money. Even when intentions are defensive, secrecy breeds suspicion. Transparency builds trust. Opacity creates backlash. Once hidden systems become visible, the narrative is no longer controlled by the institution, it's controlled by public reaction. The largest pools of capital are no longer controlled only by banks and hedge funds. They now include universities, non-profits, religious organizations, government-linked entities. Economic influence is decentralizing, but not necessarily democratizing, and that shift will shape markets for decades. Here's the truth most people miss. The Ensign Peak story didn't end with the SEC fine. It exposed a blueprint showing how institutions can quietly accumulate extraordinary financial power while operating outside traditional public scrutiny. The next generation of megafunds may not be corporations. They may be non-profits, educational institutions, charitable foundations, religious organizations. And when financial power concentrates without accountability, history tells us one thing: eventually, the public asks questions. Eventually, systems are challenged. Eventually, change becomes unavoidable. If this deep dive changed how you see institutional wealth, hit the like button so more people discover this story. Subscribe if you want more investigations into hidden financial systems, power structures, and how money really moves behind the scenes. And comment below. Do you think religious and non-profit institutions should be required to publicly disclose their investments, or does privacy protect their mission? Because this conversation is far from over, and the next financial empire being built quietly might already be happening right now.